Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carillo.
Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Nathan Trunfio, and Nathan is a real estate investor and Senior Director of Sales and Marketing at Lima One Capital, a lender offering financing to investors on fix and flip, new construction, rental properties and portfolios, and multifamily bridge loans. He has financed over $1 billion in loans for both single-family and multifamily assets. So thank you so much for being on the show, Nathan.
Charles, thank you for having me, man. It's a pleasure and an honor to be here.
So it's great to have you on. You're an investor. You're also a lender. So you know both sides of kind of what each side goes through in getting a deal closed. Can you give us a little background on yourself, both personally and professionally, prior to joining your current firm?
Yeah, absolutely. So I'm born and raised in Massachusetts. Go all things New England sports. So, sorry for those that are against them. It's been a good couple decades here, but I reside in the suburbs of Philadelphia for the last about 15 years. So coming out of college, got a job in finance in the mortgage industry. It was sort of the refi boom, as we say. And so the first 7-8 years of my career was sort of climbing the ranks in the residential or forward mortgage industry, from top producer to a quasi producing and managing role to then sort of manager and director role, running a smaller lender. So it was great for me to learn sort of all sides of the sales business and management business. But honestly, it wore on me, especially us investors know red tape, slow process. It just doesn't quite jive with what sort of our pace of life and desired pace of a transaction bodes. So I pivoted out of residential financing and went to what I'll call sort of the wild, wild west of business financing. I ran 2 different debt funds over about 4 years. So it was deploying discretionary capital to small businesses, which is such a great need for it. It was a tough product. It was expensive money because it's high risk lending to small businesses. So essentially I went from the far right end of lending, a lot of red tape and for the right reasons, got a lot of guidelines and policies, to a little bit wild west, higher risk. And then about 5 years ago, I found my happy home in the middle of the two, private lending industry. Other people on this, on the street, we call it hard money. But nowadays, our space has become extremely institutionalized. So have been a president of a pretty large balance sheet lender, and then really stepped up to the big leagues here at Lima One Capital. We're one of the top, call it 3 to 5 in the space. It's actually really interesting. It's as big of an industry as it's gotten. It's non-standardized, so it's hard to track who really is the top dog. And so running sales and just providing as much value to our organization as possible, helping us grow. We're about 150 people strong. We originate and hold and service loans all from A to Z. As you did a phenomenal job in your intro, saying we do just about all residential focused investment products, fix and flip, new construction, rental loans, rental portfolio loans, and multifamily bridge. So we try to cover it all and consider ourselves sort of best in class for the best in class is sort of something we like to say around here. So that's my story and sticking to it. Mainly that's the finance side. I appreciate the compliment of being an investor. I do a handful of deals a year just to make sure that I can relate to our clientele. And so I wouldn't say that I'm the most sophisticated in that end. Probably many of the listeners would run circles around me, but certainly see it from the lending side in high volume. We do a significant amount of loans. And so we see a lot of transactions all throughout the country with different deal strategies, different operator sponsors behind the scenes, from no to low experience to extremely high experience, very professionalized organizations, 50, 60, 70 plus people, whether it's doing many flips, owning hundreds to thousands of doors, single family, multifamily. Again, we cover sort of it all. And that's why I love this space, is anything in real estate investing, and anything with action.
Nice. So it's interesting. One of the products that we haven't spoken too much about on the show which is something that the bridge loans for multifamily bridge loans. And it's something that when I was investing a lot with smaller commercial properties like a decade ago, I mean, it wasn't even really available. You're going to a hard money lender and you're dealing with all that. And I know like when you're dealing with bridge lending, it's kind of getting into hard money for commercial multifamily is what they say. Can you explain a little bit more about where you would bring in bridge loan and compare it to more of a permanent loan and the risks kind of, because I don't think that's something that people really take into consideration.
Yeah, man, I love the question. Super passionate about all things multifamily and especially our products in it. So to sort of start at the basics, over the last, call it 15 plus years since the great financial crisis, the entire sort of bridge space in most asset classes has become more and more institutionalized. It's been institutionalized on larger deal sizes, call it middle market and up. So $5-7 million plus loans. That's been fairly prevalent, but there's been a huge void in everything below that, which is a lot of where people start, cut their teeth, and grow their portfolio. And so our industry, we like to call it private lending, has come in to put and fill that void. So that's just a very high level background, because you're right. Absolutely. Before that void has been filled, it was only hard money. You had to know a guy. It was the hard money guy or girl. And, they bang you over the head with some expensive capital, but it served a point. Nowadays, bridge is an extremely common and often looked at financing vehicle for multifamily for a couple of reasons, which I can circle back to in more detail, but specifically, bridge loans allows you to take a property from position and condition A and go to position B. And the loan itself is, like it's called, the bridge between the A position now and the B position at the end of your business plan. So how we look at a loan is very much what's the asset's condition now? Is it stabilized? Is it occupied? Is it performing? Where is it underperforming? Does it need CapEx, deferred maintenance, and things like that? We look at then the business plan to get the property to stabilization, and so on and so forth. That's again sort of position B. And then we underwrite off of and lend off of what is in place now, and also a combination of what it will be. So it's the as is valuation tied to an as stabilized valuation in the multifamily realm. And we're analyzing a sponsor operator's business plan. Is it feasible? How long will it take? What will it do to sort of financials and profitability and NOI throughout it, and then at the end of it. And so we're writing with bridge loans. We take a little bit more risk because a lot of our properties aren't stabilized. A lot of them need a lot of sort of heavy lift, if you will, on CapEx side, or again in deferred maintenance, to where on a permanent financing product, it has to be a stabilized property. It has to be positive NOI. In bridge, we don't have to have positive NOI. There's different ways that we can structure that. But the bottom line is the condition of the asset has to be more pristine, and it has to be spitting out positive cash flow to support the loan. And therefore, permanent financing is not as much looking at what could happen to the property. It's more of what is happening to it, and that's what I'll lend off of. Whereas us in the bridge world, we can see where it's at, see where it's going, underwrite the two and the path to get from one A to B, and then provide a loan that helps facilitate that. So what does our loan look like differently? They're almost always, call it shorter term loan, shorter duration, just because most permanent financing vehicles, end up, whether it's, 10-year fixed or 20-year, 30-year amortization. We are typically a 2 to 3 year interest only product. So therefore your cash flow or your debt requirement is lower because it's interest only versus an amortized principal and interest product. And then also we're typically financing some realm of construction holdback, CapEx, if you will. And so that is put into the loan. And when we are doing all of those components and analysis, it also typically will be able to provide a higher loan amount, higher leverage than a permanent financing product. Again, just because we know that an operator is going to reposition it and realistically create value. By creating value, everything improves, and we can therefore, lend a little bit more because we know that you're going to be increasing value, which will support the loan as it continues to progress in the plan, the business plan and reposition.
Yeah, interesting. I had a partner that brought us a deal with bridge debt on it that was going to be part of the business plan. And just so I can give the listeners an idea of what this was, and obviously it wasn't from your firm, but 7.99%, 3 years interest only, 1 year no payments, and this is like the type of thing, and you're probably, so you have that 4-5%. You're paying higher over probably a permanent loan you'd get with a Fannie Freddie or another, or some sort of bank or a credit union. But that's what you're able to do. So you have a year before you start paying this interest only, and then you have 2 years there. So you have that 3-year window to get it up and running, get it seasoned, and get it refinanced or sold.
Yeah. I mean, look, that's very comparable to how we look to structure something. Thankfully, we are a little bit sharper in pricing than that. So thankfully, but at the same time, it's essentially a difference of 1.25% to 1.5% in interest rate. Is the equivalence of an interest-only payment versus an amortized 30-year payment. If you can get 30-year amortized, if you're going traditional banks, a lot of times they're shorter duration. So again, it just puts it in perspective that even though a rate might be higher, the debt service is lower, which allows you to afford the payments. And many times we'll wrap the first number of months payments into the loan because we know there's low or no cash flow at the beginning, because the plan is reposition it and create value and create increased cash flow.
Yeah, that's great, because then the operator does not have to raise funds that are going right out the window for debt service. We can now we can put those funds that we're actually getting in, whatever portion of income that's already coming in. Hopefully there's some income that's already coming in on the property. We can use that for building up our reserves and then using it for the repositioning. So that's an awesome benefit. Can you explain to us who is a bridge loan used for? I always tell people not to get one on their first deal or something like this. I'm like, go with something that's a little bit more already set that you can walk into, permanent lending, permanent loan kind of situation. What would you suggest when someone comes to you that they can use this product?
Yeah. So really great question. And the way that I would answer it, I think your guidance to anybody starting out in multifamily is probably wise, because you would think it's sticks and bricks and people in tenants or residents in a unit, and they pay rent or they don't, and you just collect money and everything's good. It's it's the good old mailbox money. And stabilized or non-stabilized property, you run into challenges, and it's a lot. So removing any component to where you have to reposition and take a property from A to B may be the best route for somebody getting into the multifamily space. So that's why I would say definitely agree with your feedback. But to your question, who and when would it be used for? First and foremost, there's a number of assets that just won't qualify for traditional debt. So let's reference agency guidelines. Agency, you have to be at 90 for 90, as they call it, 90% occupied for the last 90 days in order to be eligible for most agency Fannie Freddie multifamily loans. So if you're not 90 for 90, you probably need a bridge loan to then further stabilize the property to get to 90% occupancy. So that's number one. Number two is when you're buying a property that has a very clear path of value creation. There's two main types of value creation in multifamily. I'm sure you could create a bunch more categories or subcategories at that, but it's either value add by, investing money into increasing the quality of the asset, aka investing capital expenditure dollars, or renovation money. You're renovating units, and you renovate a unit so you can get more in rent. And then that higher rent's going to give you a higher yield on the property. So that's number one. And then the other one is typically like the mismanaged play, whether it's a lower occupancy because just management wasn't good at leasing and retaining their tenants, or just other challenges with somebody running a property at stabilization. So who's going to use those products? Somebody that can see an opportunity, buy a property, maybe and hopefully at a discount of what the stabilized value is going to be. And they have a clearly defined business plan on, again, how to get from position A to position B. So circling all the way back to the point you made up front is, if you're a newer investor, to really be able to lay out a business plan and then more importantly, execute on it is a lot to take on. Because I'll say this, Charles, I don't think, and tell me if you would confirm or deny, I don't think I've ever seen a pro forma that looked bad, right? Like on paper, it's really easy to show this is the plan, this, whether it's a stabilized property or not. So the real question becomes, is it feasible? Number one. And do you have the capabilities to do it? Do you know how to do it? Do you have the resources, the connections, whether it's, contractors or better property management company and so on and so forth. So hopefully that paints a pretty detailed picture on who and when somebody takes out a bridge loan. I will last say, it is extremely common nowadays for people to look for bridge loans to try and get higher proceeds, a higher loan amount. Higher loan amount means you don't have to invest as much equity and money into the deal up front. So what we're now having to underwrite and try to protect everybody against, let's hope we're not at the peak, but we're at the peak or close to the peak of the market. So how much more room is there for cap rates to compress and you to just buy a property and hold it, and it just increases value because it appreciates? So we're really having to truly underwrite the business plan and make sure that there's validity in creating value, because otherwise nobody wins in that scenario. The property doesn't perform. Nobody can give a permanent financing product on it. And then nobody wants to buy it for anything more than the last person because they bought it at the peak of the market. And we are extremely diligent nowadays to make sure there's not sort of falsely created business plans, and that there is true value creation when we're going to write a bridge loan.
Okay. So with the lending environment, like you were just explaining, how has everything changed? I mean, I would consider us really kind of post-COVID. We're on the, we have some, obviously a lot of effects from it that we're still going through. It might go through another year between everything with shortages and everything like that. But getting back to lending, how has the lending environment changed now? Obviously, you're looking at a lot more business plans. But when we were back in like 07 and 08, and there was a lot of no doc lending programs are out there, which as you were in there, you probably know even more than I do, that kind of led us into this recession. Have you seen any of these products coming up? Obviously, I see 80% loan to value on bridge loans all day long and stuff like that. What else? What do you see kind of going on with where we're getting in this frothy market?
Man, and I love the F word. That the frothy market is the best way to describe it, man. So look, let's be transparent. The great financial crisis, lenders were scapegoated for a big reason for the crash, and honestly, very rightfully so. As a result, and one of the reasons that pushed me out of residential lending, and I know we're talking multifamily, but everyone's become a lot more sensitive, whether that's the government-sponsored entities that oversee a lot of this, that provide liquidity to the market. Fannie and Freddie is who I'm referencing there. They've imposed a lot more strict guidelines to get away from, stated no doc loans, because it hurt the market. People were lending too much on valuations that were too inflated. And so not only that, but then the money providers, the banks, the lenders behind it, they tightened up as well. So I'm very confident that, look, anything can happen in these market conditions. There's a lot of economic distress that's either on the surface or could come to the surface. I am very confident that lenders will not be a big reason or a reason for any sort of crash. I think it'll be other items. But what's different is, again, just a lot more diligence in how loans are underwritten. There's no more of that sort of fly by the seam of the pants. And if you want money and you got a pulse in a property, I'll lend it to you. That doesn't happen anymore. And then more specifically in a shorter window with the whole pandemic that happened to us all, you definitely better have had your seatbelt on when looking at different financing vehicles over, almost the last year, but, the last couple of months it's settled down. It was a choppy ride. Lenders pulled out, they paused. But the good thing is almost everybody's come back. The products, everybody, how do you reduce risk as a lender? You give lower loan amounts, you increase rates, things of that nature. So that all happened over the last 12, 15 months. But now things are settled back down. The market is still frothy. In order for people to buy properties and show a good yield to themselves or their investors, we as lenders have to provide cheap debt because, again, the prices are so crazy. So with the cheaper the debt we provide, the more diligence we have to do. That's what we learned from the great financial crisis. So there were a lot of things that have changed in the last, again, 15 months in lending, but we're actually back to where we were pre-COVID. If anything, I've started to see some products and pricing, like interest rates of products, get even more favorable than when they were pre-COVID, just because, again, there's so much more pent up demand and even less supply than we ever had before the pandemic. So therefore, we on the lending side want to deploy money, and therefore we got to sharpen up in order for good operators to be able to buy properties with our financing and drive yield for themselves or their equity partners. Interesting.
Okay, great answer. What so an investor's listening to this show right now and they want to reach out and start with you. When does a investor supposed to reach out to like a lender like yourself? Are they doing it when they're thinking about buying, when they have a signed LOI, when they have an executed PSA? I mean, how does that work? How do you like to have it done?
Look, I'm one in that regards. It's always going to look on the side of conservatism. So, we have no problem analyzing, underwriting for an LOI, a property that somebody doesn't even have under contract, because we're big believers in we want to make sure that a sponsor borrower is prepared for what we would require on the financing side, and then what they can get and what they need to go, source or raise or invest in their equity side. So my guidance is always do it earlier than later. Very frankly, Charles, most people, though, don't necessarily take up that advice. You'd be so surprised, and maybe not, at how many people lock up a deal and then they start looking for their lending options, and as you probably know, also for their equity options, right? Which is it's a delicate balance, right? It can be very difficult. But nowadays, most lenders will look at pre-qualify, whether it's a soft quote, as we call it, or an LOI. A deal at no cost and no obligation, no fees. And that's what we do too. So anything that we do to give guidance on what we can provide financing is free, no cost, no obligation. Therefore, I always just tell you, might as well start earlier so that you can better put your pro forma together to make sure that the cost of capital and everything else is going to work, and that you get the right returns based on how much equity you have to invest in a deal.
Yeah, and they should also reach out to you and get an idea of what's going on. So if you tell them, hey, these properties that you're targeting, we can only do 75% loan to value, just making stuff up. And then and then we know where this is a spread, and we know this. So now when they're out there, they don't have to call you every 5 minutes and say, hey, how about on this property? How on this? Now you have an idea, and they can use that when they're doing all their numbers through their underwriting. So when they bring you something, then it's all set. To the most part, maybe something's changed in that time frame, but that's just what it is. But it's something where,
100%. So real quick, I know we're talking mainly and focusing multifamily, but on the single family realm, we actually encourage you to do it as early as you would want, because we will actually approve you as a borrower, tell you all the types of financing we can give you for a fix and flip or a rental loan up front before you even look at any properties. Now on the multifamily side, there's a lot more dependency on the asset, but we can absolutely give generalities, especially for specific markets if you're targeting an MSA for an acquisition, and then also analyze what your qualifications are as a borrower too, because you're right. Like, you should want to know how much leverage, because that's going to depict how much equity you got to invest or raise, and then also what your returns are going to be, whether cash on cash or IRR.
Yeah, that's great, because I actually had someone email me today about when they should get approved for a hard money loan, if it's beforehand or after. So, and I was like, usually you talk to them beforehand, stuff like this, and they said they're lender. So I was like, they got to get a different lender, but I'll send them your information afterwards. But I always like talking to you when I'm talking, we're in this market, the frothy market, and you must have people calling you all day long, asking you about, I'm a first time investor, whatever it is. Anybody in commissions, I like asking them, when is an investor that reaches out to you, and how are you able to recognize that they are serious and they warrant your time or someone on your team's time?
Ooh, that's a great but tough question. Because I'd love to just give a simple, it's sort of a gut instinct because it's somewhat is.
Yeah.
But look, in the private lending world, a lot of how we qualify a borrower, it's more non-traditional. We're not looking at your tax returns. I don't ask you for personal or business tax returns, so we're not looking at that type of stuff. What we look for is proof of execution and formal experience. So you can't always, not everybody has experience, and you always got to start somewhere. But the bottom line is what I tend to hear and see, and this comes also from a little bit of the business lending experience, running credit and making credit decisions, is listening to cues on people who would, if they could, do something, versus somebody who says, no, I'm doing this now. I did this before. And it doesn't have to be you bought a property. It could be, I looked at this acquisition. I put in an LOI to buy it. I lost it, but only because I underwrote it diligently and I was more conservative, and they wanted a frothy price per se. So, to me, very conceptually, I look at people that are doing versus people that are talking about doing. And to me, that's one of the sort of instinctual signs to me of, if you're doing something, you're more likely to run into results, right? So massive action equals massive results. No action always equals almost no results, right? So that's from a very high level how we'll look at that. But again, it ties also into proof of execution. Have you done it before? If you've done it before, you're likely going to do it again. And we'll help people of all shapes and sizes. Again, no experience to extreme experience, professional. And to us though, it's a phenomenal question, because myself and my sales teams are asking ourselves that question almost every single day.
Yeah, I would imagine so. What are common mistakes you see real estate investors make?
Yeah, so I'll tie it into, sort of bridge realm to having no detailed business plan. No realistic or obtainable business plan is easy to specify, but even more importantly, not really having a business plan. How you're going to navigate through whether you're repositioning an asset or you're just buying it and going to run it the same way that has been run by the previous owner. You have to have a specific business plan. And, there's a level of too much specificity, but at the same time, the biggest fault that we see is, I said this same before, fly by the seam of your pants. Like, oh, I'm just going to buy it. It's a great buy. What are you going to do with it? How are you going to sustain the profitability and cash flow and performance? Oh, I mean, it's doing good now. It's just going to be great later. You got to have a business plan. That is the biggest reason for people to fail. And then the other thing is, it's cliche. It's talked about in most investing circles, but it's tried and true through every single economic cycle. You make your money on the buy. So you have to do diligence to make sure that you're getting a good purchase. If you're buying a property right and at a so-called discount, then you have a little bit of buffer room for error, because we all make errors and real estate forces us to make errors. It can be unpredictable. But you need to have diligence on any acquisition, single family or multifamily of any shape and size. And without that, you're going to run into challenges, even in a market where there's been all this tailwind behind us and cap rate compression and things like that.
Great answer. What do you think are the main factors that have contributed to your success, Nathan?
It's just one. I grind it out, man. I will outwork anybody. I mean, no, I know many people work harder than me, but that's my mentality. I was born with some God-given knowledge and talent in that regards, but I'm certainly not the sharpest. I'm definitely not the most skilled or experienced, and I'm certainly not the best looking, that's for sure. But I will work my butt off. And to me, you look at almost anybody of success, that is synonymous. So I have this inner burning clock that just keeps driving me. I love the word grit. Great book by Angela Duckworth, to plug that. But having tenacity to persevere on short-term initiatives through long-term goals is sort of what keeps me ticking and what's led to any realm of success that some of my deem. Awesome.
So how can our listeners learn more about you and your business?
So very easy. Our website is limaone.com, LIMAONE. You can find me directly, limaone.com/Nate. It's sort of a specific page. There's an inquiry form. You can shoot your information in there and we can reach out. Otherwise, on all social medias, Nathan Trunfio on Facebook, on LinkedIn. We pride ourselves in putting out as much valuable content. Hence why why I'm in this podcast here, because I see nothing but valuable content from everything from you, Charles.
Well, thank you so much. I will put all those links into the show notes, and I want to thank you for coming on today, and hopefully looking forward to connecting with you in the near future.
Absolutely. Thank you, Charles.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars LLC exclusively.